Hey guys, Mark McMahon Real Estate. Today I want to talk about the coming crash in 2023 of the real estate market. So let's dive right into it. All right, overall, so far the market is not down. Why is that? Because prices increased so much at the beginning of the year that we're still at about and this is California, about a 5.5% price increase overall for the year. It was much higher before, but prices have come down. The one thing that we're going to be looking forward to next year for 2023, and this is according to CAR, which is the California Association of Realtors. And guys, the reason I like to use them as a source is because they are going to be the ones that want to make it as rosy as possible in the forecast. In other words, they're going to want to make the market look better than it really is because they're in the business of selling homes. A strong housing market is a really good thing for the California Association of Realtors because that's what they do for a living. So what did they say for 2023? Right now, we're looking at a 7.2% drop in existing home sales. What does that mean? We're already not selling that many houses due to inventory. We know inventory is going up as we speak. They're still forecasting a 7.2% drop in sales. So as prices decrease and as interest rates increase, inventory historically will go higher. They're still saying that we're going to drop over 7% in sales. That's big. That's big when you consider that inventory is going to go up. We don't know how much inventory is going to go up. We just know that it's going to based on history. And history does tend to repeat itself. CAR is also saying that the median house price is going to drop 8.8% based on the same numbers that they're looking at. Interest rates, inflation, job market, they take a lot of things into consideration, but mostly it's just historical facts. They're going off of what happens when these types of rate increases happen, when there's a high rate of inflation and people are scared. Inventory goes up, prices come down, and also sales go down. So that's what we've got to look forward to in a market. So we know that it's not going to affect homeowners too much, but here's the caveat there. As jobs decrease, which we're already seeing in the tech sector majorly and the real estate sector, other businesses will be affected, right? So the people that do the janitor work for the real estate offices, the people that are working in tech, that are building their offices and supplying their doorknobs and their toilet paper and their tissue, those businesses are going to see decreases in volume, right? They're not going to be doing as much business as they were yesterday or last year or the year before when things were great. So what is that going to do for everybody else? That means there's going to be layoffs in those sectors also as the businesses decrease in their income. So what does that mean for real estate? It's going to decrease real estate prices even more, and there are going to be more people that have trouble making their house payments, thereby increasing foreclosures. I know there's a lot of people out there right now that are still saying foreclosures are not going to happen because it's quote unquote different this time than 2007, 2008. I disagree, because whenever everything in an economy drops, the housing prices will too. And that's what's going to happen this time based on job losses. If all we've got to go off of right now to make it super simple is job losses, anytime any sector of business, let's just take tech for an example, does a lot of layoffs or firings, it's going to affect the general economy because of the reasons I stated earlier. But what that also does, though, is it's going to drop the price of real estate. It's going to make a lot of people that bought real estate in the last couple of years feel pain, right? Now, perhaps they're locked into a low interest rate, but they're also locked into one of the highest prices or the highest price in history of housing. So they're going to be feeling that pain as the prices come down and they can't make their payments. So they have a couple of choices. They can do what we call catch a falling knife, which is price their house low enough to actually sell quickly, or let it go into foreclosure, or simply short sell it. We'll see what the banks decide to do on this one. I think short sales are going to be big. I also think foreclosures are going to be big. And I also think people are going to be selling their houses for what they owe, because they can't afford to make the payments. How widespread this becomes, I don't know yet, but it's going to actually happen. So we need to be ready for that. What does this mean for us as investors? If that's why you're here right now, I'm going to tell you. When I got involved in real estate, we were in a massive down cycle. So we bought our first rental property in 2004, and we saw prices go up astronomically and then fall off a cliff. And we ended up having to short sell that property. We then started buying properties up at discounts in 2009, 2010, 11, and so on. And we ended up building up a pretty decent sized portfolio that's worth quite a lot of money right now. So I can foresee something similar happening. One difference is going to be there's going to be more investors in the game because there is still a lot of cash out there. But there will still be a lot of opportunity for investors like yourself that are just getting into the game. You just have to learn what to do to get those deals and make sure that you've got the financing in place to pull it off. That's the two most valuable things I can tell you to study is how to find deals, how to research deals, and how to fund them. If you learn those two things, the rest will come. All right, there's a YouTube video on everything, but those two things right there are the ones you want to watch. And we've got a couple of videos on that we're going to post at the end that you can watch. So as the market corrects, what steps can you take to get started investing today? Well, the first thing I would do is start researching the area that you want to go invest in. All right, that's number one. Find an area that makes sense to you, that is affordable, and hopefully close enough that you can self-manage it. Once you've found an area to invest in, you need to learn how to comp properties there. You need to find out what a property is worth. You need to find out how much money it's going to cost for you to fix it up. And you need to figure out what you're going to do with it. You're going to have to figure out whether you're going to wholesale it, you're going to flip it, or you're going to buy and hold it. And that strategy right there, one of those three strategies, once you've decided that, you can move forward with what your game plan is. The third thing you need to do is find financing. You need to figure out how to pay for this. Now, we use private money, and we also teach people how to find private money. We also teach people how to find properties and analyze them. But finding private money is going to be probably the most key thing to your success as an investor. Barring that, you're going to have to do traditional financing, which would be through a bank or a hard money lender who typically charges a much higher interest rate and points on each loan. Hard money lenders are usually the gateway for most investors to get involved in this business. However, if you can find private money or you can get a good rate from an institutional lender, it's much more preferable. If you want to learn more about investing, subscribe to our newsletter down below. You'll get lots of great tips on how to get involved. Guys, thanks so much for being here. I appreciate it. Please like this. Please leave a comment and sign up for notifications so that every time we drop a video, you get notified. Guys, I'll see you next time.